So in classical finance, investors are rational and prices reflect all information. Okay, that was where we said it in terms of the efficient market hypothesis. The behavioral view, investors make systematic, predictable mistakes. Gesundheit. Errors aren't random, they push prices in specific directions. Okay, we did see an example of that. We saw we saw after a big earnings move or a big news announcement, we saw the big ones that moved down tended to keep going down, and then the ones that went up kept going up. We'll get into why that happens. Two roots of inefficiency: information processing errors, misread or overreact to data. Okay. Behavioral biases, emotional and cognitive shortcuts distort judgment. So it's like how we box things, you know, how we box thinking about a situation can actually influence how we decide how to respond to it. Here is like, you know, we can misread or we could overreact. So, you know, denial, shock, these can all lead to different, you know, patterns of behavior. So give you a nice little table to compare these two. But the key differences are that, you know, the EMH is assuming everyone's rational, and behavioral says you're prone to biases. You know, here predictions are returns are unpredictable. Here predictions, some short-term patterns may exist. And we'll get into momentum and reversals, which get into technical analysis. How does this all fit? Cognitive bias, individual errors, decision errors, limits to arbitrage. Because we talked about, we had APT, and APT forced everything into the same place. Here we say, well, we can have something that's in the market and it persists. It doesn't get arbed out. We can use technical analysis. We can find the footprints using these tools, okay? So we go through and use different technical analysis tools, you know, moving averages, and but we have to be careful in terms of doing data mining, illusion of patterns, you know, like when you're laying on the side of a hill on a sunny day watching the clouds go by and you say, oh, I think that looks like Snoopy, right? So it's not Snoopy, it's a cloud. Your brain has we are wired for basically putting structure and patterns on top of things. Synthesis, adaptive efficiency. It helps us orient us, help orient you to like what's going on when you're looking at behavioral science or behavioral finance. Why do we misread? Limited attention. I don't have enough time to look at everything, right? You give me a lot of information and you know, I give you a page full of numbers. How do I figure out what that is? Okay. Investors are going to process information slowly or selectively. Underreact. Price drift as news sinks in gradually. That's where we're seeing momentum. Okay, we see momentum, and that's something we would see in a the moving averages divergence. We would find that's where we come in. Overreaction, excessive optimism, pessimism causes reversals. Okay, you know, I mean that's kind of what happened in the internet bubble, right? So there was like a lot of optimism, and then eventually people saw that, well, they're not going to get the returns, and so the pessimism kicked in. Another one is overconfidence and excessive trading. Somebody who sits around and trades all the time, okay? They believe they can outsmart the market, outsmart the crowd with a high turnover, but it actually and with like a lot of small returns over time. But inefficiencies don't come from ignorance; they come from how attention, emotion, and confidence interact. Okay. Have you guys ever heard of Kahneman and Tversky? I think Tversky has a book, Thinking Fast and Slow. But yeah, they were awarded the Nobel Prize for their work on and they're not economists, they're psychologists. So mental shortcuts and emotions. So framing effects, how we describe gains, losses changes our choices. People are risk averse in gains and risk seeking in losses. Okay. So what's that? You know, the adage is, you know, people take their gains too quickly and they let their losses run, when you should probably do the other way around. Let your profits run and cut your losses quickly. But people get attached to when they make a trading mistake. Mental accounting, separate buckets for money. Okay, they account for money differently depending on where it came, on it differently. So like a vacation fund versus retirement fund. Quick capital gains versus long-term capital gains leads to inconsistent decisions across buckets. So they'll take way too much risk over here, and then they're not taking anywhere near enough risk over there. Okay. Regret avoidance, fear of admitting mistakes, holding your losers too long. Okay. Herding, comforting crowds. Okay. This can actually be professionally rewarding, though, by the way. So if you're a fund manager and you're a fund manager and you know that your 20 closest peers all own, you know, stock XYZ. Well, if you own XYZ and it goes down, you and all your peers are going to look bad, but you all look bad at the same time. Or if it goes up, you're going to look great. Or you're going to look great, but your peers are all going to look great. So you're all in the same herd, so you're not going to get fired. Okay? But if you decide, I'm not going to own XYZ, and XYZ takes off, your peers are all going to look like geniuses, and you're going to look like a fool. And you know, on the flip side, suppose that they all own XYZ, but you bought ABC, and they don't own ABC, and ABC goes down. You're going to look like a fool again because you're going to lose a bunch of money, and they're going to be fine. So there is a lot of herding in fund management. So there is, I mean, a lot of these guys basically spend all their time just figuring out what their peers have. And a lot of it's published, by the way. Mental accounting, okay. We take more risk with house money. So basically I just did something, I did something and I got surprised and I have $2,000 I didn't know I had. Okay, so now I'm going to go buy, $2,000 of lottery tickets. Or I'm going to do something more risky. On the other hand, I did this trade and I bought, National Dust Corporation, and National Dust Corporation just has gone down 20%. I hold on to it because I think the National Dust is eventually going to come around. Okay. Regret avoidance, people hate admitting mistakes. And the market implication is that these produce predictable returns. Underreaction to bad news. Denial, regret avoidance. What did we see when I showed you, news came out? Right? That the tail loss was the same as the initial loss in terms of its relative size. That's basically, those are the people in denial. Momentum's driven by momentum driven by herding. So basically, everybody getting in, it's going to keep pushing the stock in terms of going in a particular direction or going another direction. Reversals happen when the emotions swing. So basically, okay, these internet stocks are never going to pay off like they originally said they were going to. So now I'm gonna get out. So somebody gets out, and the first person who gets out, they sell, and somebody else, that's somebody else's signal to sell, and you eventually end up with a big sell-off. Behavioral finance isn't about stupidity; it's about humanity. Okay, you're just dealing with the human component of how people make decisions. So this is a good summary of shortcut framing. Market effect is loss aversion. Mental accounting, inconsistent risk exposure. Regret avoidance, holding losers, herding. Anchoring. And this is, people do this in all kinds of places. Anchoring comes in terms of like, and you see a lot of companies make these decisions. I've watched a number of banks in terms of like IT projects. It's like, we spent $30 million on this derivatives portfolio pricing and management system, and it still doesn't work. But by God, we spent $30 million, and we're gonna make this thing work, and then, another $60 million later, something, probably some outside but I've seen a number of places where they just keep putting money into something that's bad, very often in projects. That's an anchoring effect. So basically, you don't react to it because you're looking at what you spent. Look at what you've got invested, and you're not looking at it saying, reevaluating, taking a step back and saying, okay, this didn't work the way I thought it was. What's wrong? What should I do? Okay. Evaluate the new information. This is a nice little funky graph of, what happened. We had our original utility function, but here we say that people have, when we put in prospect theory, they have this sort of like flipped. So this is losses and this is gains. So then when we look at, in terms of the, delta and change in wealth, we see that there's this risk aversion coming off the tail. So this here is that guy, but now we're accounting for the fact that people are averse to losses. So why mispricing can persist? Now this is a classic example. This is one that's puzzled me for a long time, puzzled a lot of people. Royal Dutch is a company listed on the Amsterdam Stock Exchange. Shell is a company listed on the London Stock Exchange. Okay? They're both owners of Royal Dutch / Shell. So that all the assets are owned by, it just happens to be that some of the shares are issued in Amsterdam and some of the are issued in London. So theoretically, they have the exact same claim on the profits of the firm. Okay? Yet, so we would expect them to trade with the zero price differential. So in other words, if I looked at the Royal Dutch share and I adjust it for foreign exchange, I compare it with the Shell share, they should be worth the same. They should be roughly the same. They can differ in price by, 15%. Okay, and this plot, this is 12 years. This has been going on since first time I saw this. It's been going on for a long time. Okay, so why would that happen? Okay, under pure efficiency, arbitrage should erase this deviation, but it doesn't. Okay, The barriers. We don't know when it's going to converge. Okay, and you can see these are two legal documents that have the same economic value, but they don't have the same legal force, right? There is like a revenue sharing that's clearly defined, but I can't take a share of Shell and go to Amsterdam and hand it over and say, and short a share of Royal Dutch. I can't hand them a share and then say, here, take this. They're economically equivalent. It's like, no, legally, yeah, economically they are, but legally, one's under, Dutch law, the other one's under British law. The prices could move further apart before closing the gap, okay? And if they do, you're going to get a margin call and you may get liquidated. Implementation, short selling and cross-border trading are very costly. Okay, tax, regulation, borrowing fees. They didn't used to have shorting in London. It was only dealers could short. Model risk, investors cannot be certain the pricing relationship is stable. Getting into capital constraints, that's more like the broader question, like why is the broader market not driving this back into place? Behavioral and structural factors. Dutch and UK investors treat the two listings as separate markets. It's not unusual to see one of them moving up and the other one moving down on the same day. Home bias, investors prefer their national share. Takeaways. No free lunch does not mean instantaneous correction. Okay. There are very few things. So, like the way the S&P 500 works, the future works. You will know that at the future maturity, when the future is maturing, it would be priced on the opening price of that day that it matures, okay? So let's say you had bought the shares and you had sold the futures. So the futures are going to expire. So whatever you sold the future at and the difference between that and the price at that time is going to be what you owe. So how are you going to get out? Because you own all this stock. You're going to sit around and, sell this stock, sell that stock? No, you go in, and you can do it with a button now. You're going to sell all your shares on the open of that day. And if you say, I'm selling on the open, whatever the price is, you're guaranteed to get that price. Well, that's also how the future is going to be priced. So on that day, those two instruments are perfectly aligned on that day. Okay. Any other time between then, so you could say the basis is rich and I'm going to buy the cash and sell the future, but it could get richer. And if it gets richer, it's just like then your broker's going to call and say, hey, by the way, we know we let you do this trade for $1 million margin, but send us a couple million more because the trade got richer. Okay. So again, perfectly that these two shares have the exact same economic value. So there's a mispricing can persist for a long time. We mentioned about overconfidence hurting a momentum. Traders overestimate skill and underestimate risk. Early winners attract imitators. Prices reinforce belief in the trend. Extrapolation bias, this time is different. That was a lot. It was Rogoff and I can see them, but I can't remember the second one's name. But basically, they wrote a book in 2007 called "This Time Is Different," basically predicting the prime bubble blowing up because everybody was telling themselves, "Oh, yeah, it's different this time." People like to project, recent gains into the future. They detach from fundamentals. Rational writers join in. You see this a lot, where somebody looks at something, and they invest in it not because they believe in it or they think it's viable, but because they think it's going to go up. Okay, so they believe that they're going to sell it at a later date to somebody who's more foolish than they are, and so they know that, and so they help drive the momentum up, and it can help and the they're like all kinds of like little groups of people, like in little backwaters of chat groups, who basically spend all their time trying to get everybody to start buying something, and they buy it and get it going, and then they basically hype it up, and then eventually they dump it. It's called the pump and dump. So feedback loop, rising prices, confidence, more buying, further price rises. Eventually expectations break, and you get panic and crash. Okay. Here's a nice little recipe for bubbles forming and bursting. Positive stock, innovation, price increases. Can you think of anything that's overconfidence and stories attract attention? Media amplifies, you end up with herding and extrapolation. Prices exceed fundamental value. Rational traders hesitate to short. If I buy a share at 100, I can lose 100. I sell a share short at 100, theoretically I could lose infinity, right? Shorting, and the short squeeze is, there are a lot. They're traders who look for places where they can find where people have overshorted something, and then they can get and they get like a little bit of a pop and positive momentum, and then they jump on it and they push it up, and all of a sudden all the short guys have to either come up with margin or liquidate their position, and so they can flip their position at that point in time and make a fair bit of money, as they all have to come in and buy and drive the price up. Trigger event, rates, profits, scandal, fear spreads. Once the market has full of fear, it pretty much trades with a correlation of 1. So it's just like it's either risk on or risk off. They don't care what asset it is. If it's a risky asset, it's going up today or it's going down today. The only difference is how much. Herding reverses, panic, you end up with a sharp correction. We had something that looked like this year. Anybody remember? Any thoughts? It's called the deep seek moment. Like a significant portion of the GDP of the US is being invested in AI infrastructure, AI development. And all of a sudden, a bunch of people come out with a model, performs as well as GPT 4.5, and it only cost them $5 million to build it. Okay. GPT 4.5, I'm going to guess, was probably in the multiple billions of dollars in terms of development. And so you had NVIDIA, you had all the major AI stocks drop 10, 15, 20%. And they did recover, there's a big question. But that should give you a little bit of a caution to think about what might happen if people decide that, maybe AI is just like the .com, but the returns are not going to justify this investment as quickly as everybody's assuming, assuming that it's going to, and what's going to happen, what happens at that point in time. And I would say the one .com parallel that I'm kind of wondering about is NVIDIA's selling chips to OpenAI on credit, and then OpenAI it's all going around in a big circle. And that was one thing that happened in .com was, like Sun was a big supplier of servers, and towards the end they were doing a lot of vendor financing. And so when you start to see a major supplier doing vendor financing, you have to say, okay, well, what's happening there? So again, if given the scale and the size, and given the move that we saw after the DeepSeek announcement, I would be a little bit skittish. Okay, so we want to get to something where we can actually see this, right? Slow information adjustment, we want to see can we get short-run patterns? Herding is going to cause a trend, and it makes the correction slower. Limits to arbitrage, mispricing is going to keep going on. But charts can capture the crowd psychology, so we can look at breakouts, reversals, reflect collective emotion, not magic. Okay. I didn't really think the text covered this quite as well, so I have to go out at some point and show you some specific examples. But the big thing here is a moving average, and a moving average is a really simple concept where you'll have a stock. I have an asset, and its price is moving up and down. And instead of looking at the price, I look at its moving average. And the moving average, let's say of 20, equals the average price of the price at t minus 1, t minus 2, t minus 19, I guess. Okay. I can do the same thing. I could have the moving average of 50. Okay. Get the same thing, and what I'll see is that the moving. Let's say this is the moving average of 50. Okay, and I'll see that the moving average of the 20 is moving like that around the moving average of 50, and we call these crossover points. Okay. And if the 20 is going up above the long-term moving average, it's called the golden cross. And when we see that so this would be a golden cross. And if we see the prices going down, then we call it a death cross. Okay. So what are we doing here? Well, we're trying to eliminate noise. We're trying to take out the noise. get to signal. We want to signal here, okay? And so we can look at moving averages, relative strength and breadth, gauge momentum, okay? So, and then sentiment indicators track fear and greed, okay? So the behavioral biases, underreaction, we find that in the moving averages. Overreaction, we're going to see Bollinger Bands and mean reversion. Bollinger Bands are basically where they, almost like it's calculating a standard deviation band around. So you're looking for like, okay, did this move more standard deviations? You know, it's like we expect it to move in some range, but all of a sudden you see a 3 standard deviation move. So it blows out of the Bollinger Band on the upside or blows out on the downside, and we say, oh, that's not a, you know, the band is adjusted based on what the recent trading pattern has been. So hurting, we can look at breadth and advanced decline line. Fear and greed, there's the put-call ratio and there's the confidence index, okay? Put-call ratio is the number of put buyers to puts sold to calls bought, okay? And puts, when puts are greater than calls, is considered to be bullish, because the people selling those are people who are believing the market's going to go up and those puts aren't worth anything, okay? So this is actually a pretty good example. So here we've got the actual share price and we've got a 25-day moving average. So we can kind of see that the price is much more volatile than the moving average. That's the key thing when you're using moving averages, is that the longer the period of averaging, the smoother it's going to be. So here you're trying to pick out what is a long-term trend, and so you can see here, point A, we've got a golden cross, and at point B, we've got a death cross. Okay, so we're looking for a way to break this out and figure out, is there something deviating in the underlying data? I tend to use multiple moving averages, but for confirmation. But here we've got a 50-day and we've got a 200-day. So the 200-day is going to be pretty much like a line, right? It's not going to move much. The 50-day is going to move. It's going to move slower than the share price, but it's going to move. So when we see something like the 50-day moves below the 200-day, then it's like, uh-oh. Because that's a big trend reversal, okay? So people who drew this have cautions. We're not gonna. But crossover, visualize how collective beliefs slowly adjust to new realities. Okay, so the information hits the market, but it doesn't immediately turn it into. Breadth is a good measure. So looking at the advances versus decliners. So we can see here lots of positive of advancing stocks, about 4 to 1. We look at the volume. We see that roughly they're the same volume in terms of shares, in terms of millions of shares. So strong breadth, broad-based rally. Weak breadth, narrow leadership. So basically there's a few winners driving the index. So like if you saw the index was going up, but you looked at it and you said, yeah, but the advancers and decliners are roughly equal, It's probably because there's just a few small things that are making a fairly big impact on the market. So it's weak. It says the market's weak. Volume confirms conviction. So confidence spreads through the crowd. Reading, greed, and fear. Fear and greed. Confidence interacts equals the yield on high-grade corporate bonds to the yield on average corporate bond. So basically, it's like high yield is your, your more speculative end of the credit markets. I don't know what the trim is. I don't know what they are, whatever that. But the put-call ratio is, if it's high, if there's a lot of so this is if the street's buying, or the retailers are buying. If it's high, then investors are buying protection. If it's low, there's speculative call buying. It's a greed signal. So extreme optimism often precedes corrections. Okay, so one thing I've noticed in the credit markets is the credit spreads keep getting tighter and tighter and tighter, and then when they finally snap, the world comes undone. Markets swing between euphoria and panic. Opportunity exists at the edges. I think the best metaphor was, and I think he used to wrote up and down on Wall Street for Barron's. Can't remember his name, but his metaphor was the market climbs a wall of worry. But we got to be careful when we start to place all these models on top of stuff, because what do you think about these two plots? Pretty similar. If I didn't label them, would you know what they are? Okay. Well, the one on the left is the actual closing prices for the Dow Jones. The one on the right was generated by a random number generator. Okay. So this was done by a computer. This one was done by life. Okay. So you got to be really careful, because the human, we are pre-wired to see patterns. Okay. I don't want to die from a tiger attacking me while I'm trying to get water down at the river, right? So my mind is like looking at all. We're geared for this. So we will look at this stuff and we'll find a pattern that's not there. Just like when we lay on the lay on the side of a hill and watch the clouds go by and say, "Oh, there goes Snoopy," you know. So we have by SBC pictures and noise, data mining. You know, if we have a lot of data, chance correlations are going to appear. They're just going to be. We're going to find something in there. So, and there's this thing. This is actually a phenomenon in machine learning. It's called p-hacking. It's like I got all this data and I run 50,000 regressions, and I have it come back and show me all the regressions where the p-value was less than 0.05. Okay. Is that okay? Well, the whole p equals 0.05 was based on setting something up and having a hypothesis and running the experiment, and then you say, okay, it wasn't random. But now I'm just like, now I'm looking at as much data as I possibly can, and now I have to consider the possibility that there is just still some things that happen with a p at 0.05 that are just random, because now, and there's a way to adjust the p-values for just that situation. But I kid you not, I mean, there are people who do this. There are people who run tens of thousands of regressions every single day and are looking for some statistical significance in the data. Not every backtest or anomaly reflects a real edge. You should have a theory, okay? Don't just go in and blindly start mining and trying to find some numbers that fit. Use out-of-sample tests. That's where you use data that wasn't used. Use data that was not used in the fit to predict on it, okay? But the more you look, the more you'll find. And most of what you find isn't real. Okay? It's basically the same thing again. I don't know why they had two charts for it, but this is Friday to Friday, Dow Jones Industrial. Left-hand one is real, and the one on the right is, again, generated by a random number generator on a computer. So technical analysis, what can we do? Well, can I find a predictable short-run drift based on some underreaction, hurting overconfidence? Well, now I'm going to look at momentum. Overreaction, loss aversion, looking for reversals. But one of the things that happens is discovery erodes the edge. So once people know about it, then there's going to be more money coming in. There's going to be more people chasing it. So the profits are going to shrink. And markets evolve as the behaviors are exploited. Behavioral finance explains why inefficiency exists. Market efficiency explains why they disappear. Okay? So once I know something, it's going to be, when I started in the options market in Chicago, there were a lot of people who didn't understand how to put call parity. So it was very easy to make a lot of money off of people who couldn't, basically, which is nothing more than an interest rate calculation. So eventually, trades that we were doing early on that had lots of money in them had very small amounts of money in them. Markets evolve as we learn from our mistakes. Edges exist, but they decay. Behavioral finance teaches humility more than prediction. Okay, so that was the lecture. Now I'm going to go into some examples. But does trading more help or hurt? And I think they even give a reference to the paper. I think this is a study that's done inside of Fidelity on their own brokerage accounts. But they find that investors who trade more tend to earn lower net returns. Okay. The behavioral bias that causes this, and this was possibly to do a problem for us, but in terms of understanding and why this happens, well, a lot of it's happening is they are taking profits too soon and they're not cutting losses quick enough. So in terms of the turnover in the study, they found that that the low turnover accounts exceeded the returns of the high turnover accounts by 7 points a year. That's a lot. That's an SMB return. So prospect theory, this gets into framing, okay? Or trying to understand what somebody's saying, but a retired investor says, I have been very pleased with the returns I've earned on Petrie stock over the past 2 years, and I'm certain it will be a superior performer in the future, okay? Second one is, I am pleased with the returns because I have specific uses for that money, so I want my retirement fund to continue owning the Petri stock. Okay, so disposition, interpretation. A shows that a representative bias projecting past winners into the future. B shows mental accounting, linking one investment to a specific consumption goal. These connect to prospect theory. Investors evaluate gains and losses relative to a reference point, not absolute wealth. Okay? So this person's basically saying, this is where I'm at, this is my money, this is my bucket, and this one says, oh, it's done well, I think it's going to keep doing well, projecting into the future. Underreaction, investors are slow to update beliefs. Moving average crossovers, where prices crosses its moving average, exploit this gradual adjustment, generating momentum. So, conservative bias, underreaction, we end up seeing momentum in the stock. Moving average rules turns it into a disciplined reaction tool, basically avoiding a wait and see hesitation. It's like, no, it just went over. It says buy. Okay. There's positive momentum here. I don't know where it's going to end, but there's positive momentum. Whereas, like, I've been watching the stock. It's going up. Okay, it just went up some more. Should I buy it? So it's trying to turn that into an objective criteria. So basically, average 5 to 10% momentum over 3 to 6 months after an upward cross. You can see it in table 12B. Moving average signals mirror gradual belief updating. Crowd catches up. Uses this. Basically, we're linking the technical analysis tool, conservatism to underreaction to momentum. Okay, so can algorithmic rebalancing overcome human sluggishness? Probably not, because the algorithm is running off of the human sluggishness. Okay. Fear and greed. So here we have the put-call index, put-call ratio. And we can see big moves in the put-to-call ratio in terms of looking at the S&P 500, put-call ratio at at 1 to 1. So these would be very lots of puts to calls, lots of calls relative to puts. So we can kind of map this to a signal, and in terms of, these are, I don't know why that one's red. This is a high put ratio, sell, 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 buy, buy. Not sure why that's, but basically the, and then the confidence index ratio, looking at the high-grade bond yields to the average corporate bond yield. Contrarian trading from sentiment extremes. So this is the put-call ratio, confidence index. We're looking at the signals and seeing how they change. We see fear, and then we see greed. Go from buy to we see a buy signal and we see a sell signal. Technical rule: buy when everyone's panicking, sell when everybody's celebrating. Okay. So that's behavioral finance, and I don't have any you know, I mean, again, I'm really uncomfortable because I don't have numbers. You know, I haven't had any numbers all day long. I've been waving my hands and saying this and that and the other thing, and this is why this happens. There are numbers on these, but in terms of concepts, you know, the way I see the quiz will be probably numerical on 9 and 10, because we did APT, we did a FAMA French, we did some calculations using a single factor model, and we did some calculations using a multi-factor model. A little bit of concept there, but this is going to be more concept, and I'm having a hard time finding stuff that I like. So I'm going to try to basically, I don't know if I'm going to put it into a homework or something that you can practice with, like look at some questions to try to get but these two sections are concept. So go through and look at the concepts in terms of that and try to absorb that. But also look at what we did with FAMA French and with single factor model, and be prepared to answer a numerical question that looks kind of like the problems I set. Trying to remember if I had some, God, it's so early.
Will we still have a sheet for formulas?
Yes, you can have your sheet. I actually have got two examples that I want to show. One was by a student, and I'm not certain how he could read it without a magnifying lens. And then the other student was, it was a full page, but she had like one sentence here, and a formula. So like this entire page had, I mean, his thing, like this was like equal to like what people would normally put on a full page. Well, he had a full page of them. So I kept both of them because it's like I got the two ends of the extreme here. I can't believe he could read it. I don't know how he did that. So he asked me, I was like, I usually let people just take them, but I was like, no, I'm keeping that one. Okay, any questions? I showed you the Python. You can play around with that and change the just something you can use it for. You can change the symbol in it and run that whole analysis against a different stock. But the other thing, the code that's in there can be used to pull down data. Okay, and you can then pull that data and save it. And what I found when I was trying to do these examples in the other classes, I had trouble because Yahoo, which I used to like, oh, you just go to Yahoo Finance, they give you everything. They now want like $8 a month or something for basic. It's all still free on, if you go to that Colab, all that data, let me just go ahead and